Well, target date fund just passed a huge milestone in assets. And for a lot of people, they're the default investment in 401ks. Millions of Americans are using them. But should that be your primary investment? Is that a smart choice moving forward? We'll break that all down today. Welcome in. This is Perfect Game Retirement. Glad to have you on the channel. I'm Ben George with Ryan Ledden at Black Oak Asset Management. Ryan, talking target date funds today. I'm curious as we kind of jump into this. We got a little news on it. We'll also talk about, whether or not they're a good fit for your portfolio. But do you commonly see a lot of people come into your office that have target date funds kind of as one of their main investments when they first meet with you?
Yeah, obviously in 401ks, like the article talked about. I mean, it's the default. It's the default fund if essentially nobody goes in and picks their own investments based off of what the choices are in a 401k. Yeah, I mean, the target date fund is the default that is kind of pegged to the person when they turn closest to age 65. So whatever that, because again, most of them are in 5-year increments. And so whenever you closely turn that age 65. So it's better than doing nothing, because before these target date funds, a lot of times they went into like a money market account because they didn't want to have liability for what investments the individual picked. Well, if they don't pick it, at least they can justify it with a target date fund. So I'm okay with it, better than doing nothing. But we'll get into that today. Is it the right fit for each person?
Yeah, and the reason why we're talking about it because Morningstar recently had an article out that target date funds have hit $4 trillion in assets. $4 trillion. And just to give you some perspective, just 15 years ago, 2009, that number was $272 billion. So quite a jump in the last 15 years. And obviously now, I think 8 out of 10 Vanguard 401k investors hold one today. So those numbers are pretty staggering.
They are. I didn't realize it came from just that short time span ago of having that much in assets to 4 trillion. I still don't think people can fully wrap their brain around that T word, like how much money that actually is. I mean, that's an insane amount of money to be in target date funds. But hey, the research is the research, and that's where the money seems to be flooding to.
So as we get into target date funds and kind of explaining whether or not they make sense as an investment for your portfolio long term, kind of break down how they work, Ron. I think most people are kind of aware of them, but how do they actually work? And kind of explain that process.
Yeah, like I mentioned before, it's kind of pegged to where when you turn age 65, the closest 5-year increment, whether that's a 2030, 2040. And again, I'm starting to see funds that show 2070. That's kind of an odd year to see that far out. That's just like mind blowing that number even exists. But they do exist for obviously those young people who are just starting out. But it's obviously based on age, and that's kind of the age old, like, the younger you are, the more aggressive you need to be. Okay, there's some truth to that. It's kind of those middle stages of life that, those 40s, 50s, 60s, even 70s, like what's the best fit in that scenario. So it's more growth oriented, more risky in the beginning, and then over time it kind of rebalances itself. But then it gradually tends to get a little bit more conservative, which again, the rationale or what they call the glide path, that makes sense for a lot of people, but that may not be the best fit. Just because you're young doesn't mean you need to take on a ton of risk. I have plenty of clients that are younger and they're just risk adverse. They just don't want to see the roller coaster ride. They'd rather see like a fun little mine train, just kind of hovering along, but no like thrill rides. And that's okay. Are they giving up some on the top side long term? Yeah, probably. Again, there's no crystal ball, but it's different for everyone. But the general rule is it gets more conservative as you get older, which makes sense.
Yeah, I like your reference to that ride at Six Flags over Georgia, the mine train. Whenever you want to scale it back, that's the one you would hop on, a little bit smoother. And they've become pretty popular. Obviously, you talked about they've kind of become the default, I think, for a lot of investment accounts when they're open these 401ks. It's just, hey, your money's going to kind of automatically go to here. Do you think people would kind of stay in those because they're easy, Ryan? Is it just it's a lack of kind of knowing what your options are? Why do you think they become so popular beyond just, hey, it's kind of the default investment there?
I think there's several things there. I think it's easy. Yeah, I do think that's probably the main reason. It's like, oh, okay, yeah, it's going to change for me. I don't have to worry about it. Again, some truth to that, some not truth to that. But it is the ease of the investment. I do think some people don't know what to pick when it comes to their knowledge or prowess when it comes to picking their investments inside their 401k. They may just not know. They may look at it and go, okay, which one's had the best rate of return? Let's pick that one. So that may be the way they pick. Or if they just forget, a lot of people, when they get their new benefits for their company, especially if someone's really young, like a 401k may not be, oh yeah, 401k, it may not just be a big deal for them, but they're like, I know I need to do it. I heard my parents talking about this, and they just sign up for it and they forget to go back in. So there's a lot of reasons why, but the ease of it is definitely probably the biggest reason why. And easy doesn't mean it's right.
Well, the ease is one of the benefits, right? I mean, that is simply put the reason why many people stay in them is because it does adjust for you. You don't have to really think through a lot of your investments. You don't have to worry about making the wrong decisions. But I guess the catch with that, Ryan, is that you don't have a lot of flexibility and you don't have a lot of control, right? You maybe it makes sense in the general sense of, hey, okay, you need to get a little more conservative, but not every person needs to invest the exact same way, right? You may need to stay aggressive up until retirement, or maybe you can go conservative earlier, right? That's kind of the problem with these target date funds. They don't allow you to have that flexibility based on what your needs are.
Yeah, there's zero flexibility. The only flexibility is that it gets more conservative over time. And some of them are actively managed, some of them are passively managed. So sometimes the fee structures can be completely different. And even, you may see a fund, a 2030 fund, let's say. And I love to do this because that's the nerdy part of my job, but I'll look at like different, fund families, and they have a 2030 fund, whether it's a Fidelity or Schwab or Vanguard, who cares? Doesn't matter the person, the entity or the company. But you see 2030 and you think, oh, all of them are going to be about the same. Well, that is like completely not true. And I looked up recently a 2030 fund, and we use nitrogen. Nitrogen used to be Riskalyze. Riskalyze kind of gives a number to how much risk you are taking on, called a risk number. And I looked up a few 2030 funds, and they range anywhere from a risk score of a 44. So 1 being conservative like cash, 99 being very, very aggressive, picking one stock and letting it ride. So a 2030 fund with one company was a 44, and another company, it ranged all the way as high as a 71. That is a significant difference from standard deviation, how much risk you're taking on, rates of return. I mean, I'll give you an example to the numbers. A 44 has a range of returns between a negative 8% and a positive 15%. A 71 is as low as negative 16%. So double the downside, and then as high as 21. So you're doubling the downside, but only going up potentially 6 points on the top side. So that's an astronomical difference. So people just need to be aware of what they're in.
Yeah, that's really interesting. I mean, I would have thought they would have all been pretty similar. So to hear that difference is pretty crazy. And I know a lot of people probably aren't even looking into what the target date funds actually consist of, right? I mean, you set it for the date and let them take care of the rest. So most people aren't aware of actually what is the makeup inside of those funds.
Yeah, and not that you need to read like every prospectus that is out there, because those are some boring information, but they're there for a reason. If people want to dig into those things, they can. But I mean, you can search engine this stuff. You put in the tickers of all the different fund families out there, target date funds, and then see it'll kind of tell you what the top 10 holdings are or how it's broken down. So you can easily look high level, whether it's a Morningstar or just a Google search, whatever you want to look at. You can find out information about it. You can find out the fee structure in it, what is held inside of it, what kind of portfolio mix it has, whether it's stocks, bonds, whatever it may be, what asset classes they're in. You can at least look that up. So being aware of what the fee drag is, and I say fee drag, how much the fees are inside of it, because, honestly, a target date fund, you really shouldn't pay a whole lot from a fee standpoint. If it's a target date fund, you probably want it to be passively invested anyways. You don't necessarily want actively managed in that scenario. So a lot of different things to look for. I even had some clients come in and they have different target date funds. They think that's like really diversified. They'll have a 2030, a 2035, a 2040, and a 2045. And that's just, You don't need to do that. It's just over duplicating what you do have, and it's really not going to be as diversified as you think.
I mean, is there ever a case, Ryan, where you have someone stick with their target date fund, or is it always going to be better to have more control and just pick and choose those investments to kind of make up, your risk for that portfolio that you want to have moving close to retirement? I'm curious kind of how you structure that, if you've ever incorporate those target date funds.
Yeah, more times than not, I move away from target date funds, but I do see sometimes a fit, especially for younger investors. I do see where a target date fund in your 20s and 30s may be an okay fit, because they're really not going to change that much from a risk perspective. So again, I usually recommend against it unless the 401k plan, unless the fund options are just terrible. And I'm like, hey, just do this. This is just as good as the fund lineup that you do have. But usually most 401ks, I can cherry pick 3, 4, 5, 6, however many funds, and it be a better makeup for that individual investor. But I have seen in certain circumstances where I'm like, you know what, that 2060 fund, that's actually okay. Keep it where it's at for a long time, and then maybe 10 years, 5 years, maybe rethink it. But younger investors is where I see a fit.
So I guess if someone's approaching retirement, maybe getting 10, 15 years out, maybe they've had these target date funds for a long time, I haven't really thought about it. It's okay to kind of start thinking, okay, how can I shift away from these, right? Even if you've had them for 15, 20 years and it's been your primary investment in your 401k, it's okay now. There's still plenty of time to make those adjustments, make those shifts, get that portfolio where you want it heading into retirement.
Yeah, I've seen most target date funds tend to get too conservative too quickly. And I know people are getting to that end goal a lot of times of retirement, but that's not the end goal. The end goal is when you pass and pass this money on. And obviously that's a giant X factor that no one knows when they're going to pass away. It could be tomorrow, or it could be 50 years from now, 20 years from now, whatever that may be. So I think they get too conservative too quickly. So if you retire at 65, because that's what the target date funds are based off of, you may have 30 years of life. That's a long time. So if you get too conservative, you may run the risk out of running out of money. Just like if you get too aggressive, you run the risk of running out of money. And then longevity, and then inflation. So there is a definite delicate balance when you start approaching retirement, and especially in retirement. So that's where paying more attention to it the closer you get to retirement. And then in retirement, I mean, that's our job to navigate those waters, because it's different. Month to month, it is different on where this income is coming from, what accounts, how it's doing, how it's performing, taxes. So many things involved there that target date funds usually aren't the solution for that.
Yeah. Well, as you can see, target date funds are easy, and really that's a lot of the problem with them, right? So with $4 trillion now riding on this kind of one-size-fits-all strategy and this approach to investing, it's time to be intentional, to make sure you are on the right path. So take some time to sit down with a financial professional, look over your portfolio. Black Oak Asset Management can do that for you. You can talk through your investments, your strategy moving forward in all areas of retirement planning as you prepare for that big day. But again, target date funds might be good early on, but it's probably worth reassessing and reevaluating now moving forward. So, Ryan, interesting stuff. $4 trillion. I wonder what this number will be in maybe 15 years from now. Hopefully, it will scale back a little bit in terms of the pace it's on, but pretty remarkable.
Yeah, the pace that it's been on, I don't see it changing anytime soon, but we'll see.
Yeah. Well, we appreciate you watching. Please hit subscribe wherever you are, and we appreciate you joining us. We'll be back again next week with another video. So we'll see you then.